Aashish Upganlawar is joining us from Pune to discuss market. Aashish is an old friend and of course runs in his own outfit now. Aashish, afternoon. Thank you so much for joining us. Talk to us about how mid-cap end of your portfolio is doing. I know you have a multi-cap kind of approach. You have a good mix of mid, small, large. In fact, you're agnostic to that. But just for the understanding purpose, what are your thoughts on the mid-cap? Do you think the froth kind of valuation which got built in got cleaned up in the correction?
Yes, some sort of correction is always healthy. I mean, the kind of run-up that we'd seen in the small and mid-cap space, it was too quick, and there's always a differential between the large cap and mid and small cap valuations. So it's part of being in the market that sometimes mid and small caps will rally and large caps will catch up, and vice versa. So our approach is mostly from a 3 to 5 years perspective, and we try to pick stocks, mid and small caps, if they are in the portfolio. Typically, we have a 50-50 kind of an allocation to large and kind of mid and small caps. So that end of the investment, we try to get in early into stock and try to ride the high growth phase that those companies are likely to help us with over the next 3 to 5 years. And typically what we target is maybe 3 times in 5 years kind of numbers. So that gives the kind of alpha to our portfolio. These midterm corrections are good to have, not so savvy to go out of these names. And that gives us an opportunity to collect them again in our portfolios. So I think it's good to have such kind of corrections in between.
Aashish, what are the new areas of research? What are you studying very closely now? Not exactly on the action point of view that what would you buy, etc. But what's on your radar from a study point of view, or closer look, which you're taking a look at?
Yeah, so given the run-up, typically what you look for is a combination of quality plus high growth valuation. So quality curve, you have to be pretty sure that you are getting into companies where it's not the market that's telling you basically that these are good companies, but you have to satisfy yourself that those are great companies and basically run by on management, aggressive management. So once that part of the study is done, you need to understand the growth bit of it, and of course there is the valuation. So a combination of these three, we have it on our Excels always, and so we are finding ideas right now to this combination. Basically, say very realistic is like in certain small specialty chemical companies that have, say, as I said, runway of growth seems to be 3 to 5 years, and phenomenal growth prospects, and the visibility is very high. So I think those two pockets, the APIs still remain a favorite. Mid-cap IT is something which seems to have a longer run in terms of their business growth, even looking from this time. Of course, you need to take tactical calls on the valuations there. We have certain exposure to pipe companies. So these are the pockets where we are finding good ideas. There are certain small cap and mid cap consumer companies which promise to be good ones. Some you could also we kind of analyze the companies that come into the market in terms of pipe and stuff. So that's the hunting ground for us. These are the pockets where we have spent a lot of time because on the regular larger caps and mid caps, our studies are pretty there, and we know what prices basically suit us in terms of our portfolio combinations.
Let's take a short break, guys, and we'll come back and discuss more sharper points with Aashish on the other side of this break. Right, Aashish is still in conversation with us. Aashish, your portfolio, what kind of earnings growth have you looked at after the result gone by, and after talking to the management or listening to the management on a portfolio level? What is the kind of 1 year or 2 year forward earnings growth are you looking at your portfolio level?
Our strategy is basically based on growth. And we always target having companies which can compound by, say, 25% in terms of their earnings. So there are some which would compound at 30 maybe, and some others which are 20. But that's the target, that the portfolio should deliver that kind of earnings growth. And I think what we have picked in the portfolios over the next 2-3 years, that those numbers I'm seeing very much getting achieved. The disruptions because of whatever the third wave of COVID, that can't be kind of right now factored in. But in terms of business, they are pretty much in line to grow at those numbers. And our belief is that those kind of earnings numbers, or maybe higher than that, that should translate into similar kind of appreciation per stock prices. So that's where the entire hard work goes into, to keep finding ideas where growth is, maybe a multiple of the general economy and the general market that we have. That's the entire crux of our investments.
Right. All right, Aashish, we'll let you go on that one. Thanks so much for joining us with your inputs on your way of analyzing the market and, of course, your portfolio.